Jedi Options, let's do this. We are going to talk about cash flow and cover what might be the most popular cash flow strategy, at least when you're doing an expensive stock that you don't own. We're going to be talking about the bull put spread. I'm going to take a few notes here. Meta is going to be our example, but let's get on the same page first. Number one, when you build an options trade, you have a couple variables you can bet on. You can bet on direction. Okay, that's the land of the stock trader. They're always up or down, up or down, up or down. Got to have an opinion on direction. The options market, we know, opens up two additional dimensions to trade in. You've got time, which anytime you're betting on time, we refer to that as cash flow. Theta is the Greek term. And then you've got volatility, or vega, if you want to bet on the magnitude of a move. The market of late has been choppy. It has been difficult for directional traders because every time we go up a few days, we come back down. Every time we go down a few days, we go back up. And so the majority of profits, I think, have been easier coming from theta type plays. When you look at a bull put spread, we're going to use Meta as the case study here. Meta is at $232, give or take. It has a bull retracement pattern. It's in an uptrend. Meta's been in a nice uptrend the whole year and recently pulled back to the 9 EMA. We flagged this 3 days ago on our scattering report when you had a little doji candle at the 9. Now you'll notice it hasn't taken off here. Just kind of hanging out. Just kind of hanging out. This is emblematic of the market. You know, if you're buying calls, doing directional trades, you're frustrated because you're not getting upside follow through. Instead, you're just kind of twiddling your thumbs as time passes. So one way that you can profit from the passage of time, profit from Meta, maybe just kind of hanging out here, not launching to space, is by selling out of the money puts. Okay, and you could sell a put naked. When you sell a put, you're getting paid for obligating yourself to buy shares of stock. Okay. And so what we try to do is you're trying to sell puts that we think are going to expire worthless. I want to get paid for an obligation I never have to make good on, which is an attractive proposition. Okay, you can make make bets like that in the options market all the time. So if you take a look at the chart of Meta, let's say you think, hey, Meta is going to remain somewhat bullish, maybe neutral. Listen, I just don't think it's going to go below the 50-day moving average at 210. I don't think it's going to completely fill the earnings gap. And if it does, I think 210 becomes support and we bounce. That's not a ringing endorsement. I'm not saying Meta is going to go to 300. Just saying it's not going to go below 210 over the next month or so. Fine, you can make money off of that. You can make that bet. You could sell the June 210 put. In fact, if I go look at that right now, if I go to the June monthly, I go to 210. It's got about an 18 delta, by the way. That means you have about a 82% chance of profit of that being out of the money at expiration. So if we sell this put, you're going to get $275. Okay, so I'm going to sell that for $2.75. I could stop there. I could just say, hey, I don't think Meta's going to go down there. I think those bozos buying that put are going to lose their money. They want to give me $275 for me obligating myself to buy Meta down there. Fine, I'll do it. I don't think it's going to happen. Okay, I think I'll keep their money. Well, the problem that you run into sometimes when you sell a put, this is considered a naked put, is you have open-ended risk. Open-ended risk. You have to buy 100 shares of stock at 210. If Meta goes down to 100, you're out a lot of money. And so the broker will hold aside something like maybe 15% to 20% of the stock price to cover that risk. And that's fine if it's a cheap stock. It may not cost that much, but see, Meta's $200+. And so it becomes a little bit costly to sell naked puts on expensive stocks. So what you do with a bull put spread is you turn that unlimited open-ended risk of the naked put to a limited defined risk trade by buying protection. So we're going to sell this 210 put, and we're just going to buy the 205. Same month, sell the higher strike, buy the lower strike. What that does is it gives me the right Okay, when I buy a put, I pay for the right to sell shares of stock at that price. So essentially, I'm going to be obligated to buy at 210, but I have the right to sell at 205. So even if beta goes down to 200 or 180 or 150 or 100, my risk is capped because I have protection. Okay, I'm selling a put for premium, getting paid for that higher strike put, and I'm using some of the premium to buy insurance protection to limit my risk. It's going to cost a little bit of money to buy that put, but it's potentially worth it. Okay, so to complete the bull put spread, I already sold the 210 put. I'm just going to control click and buy the 205. And right now, you're getting about a 70-cent credit for that $5 spread. If you look at the numbers here, you're risking 430. To make 70 on 430 is about a 16% return. Okay. And that might be a better ROI than you would have got on the naked put because the cost is so much lower here. Listen, these are very variable, malleable. You can adjust and build infinite variations with this bull put. Okay. But I love the idea that I can find a stock that I'm not all that bearish on, probably bullish, maybe neutral. I can sell these out of the money puts in a defined risk manner. I can get a high probability of making 10, 15, 20%. And then with good management, I just make money over time with this. I'm telling you that over the last few weeks, over the last month, over the last couple of months, really, like this year has been pretty good for cash flow traders because the market, by and large, has been going neutral to bullish. It's been a good cash flow environment. And so while directional traders are beating their head against the wall here the last month, these put sellers, these bull put spread traders have just been lobbing out of the money puts, either undefined with naked trades or defined with the bull put, and have been collecting cash as time is passing. And that's why you hear coaches like Mark saying, listen, Mark is just kind of hanging out, A-okay with me, because he's selling puts. He's selling calls, he's doing cash flow trades, and bull put is just one of the basic ways you can do it with a very low cost.